Hey guys, good afternoon and welcome to MF Corner. I'm Pavitra, with me is Sonal, and today we are going to talk all about hybrid funds because this category has been getting a lot of money of late. You know, hybrid funds in December pulled in around 15,000 crores. If you take a look at all of 2023, that number was close to 90,000 crores. All this while debt funds were seeing an outflow. So why is the mood so positive on this space? Will it sustain, and which subcategory is really best suited to you? Sonal, let's find out.
Yes, and 2024 is going to be very interesting. A lot of geopolitical updates and our own elections as well. So let's welcome Feroze Azeez, the Deputy Chief Executive Officer at Anand Rathi Wealth. Feroze, welcome to the show. Always a pleasure speaking with you. So thanks for coming by. And you know, as Pavitra was mentioning, hybrid funds have seen a big inflow in the month of December, all of 2023 as well. Do you think this will sustain in 2024? What is making this category so attractive that people seem to be putting in their money here?
Yeah, sure, Sonal. Good evening. It's so nice to be on your show. From a perspective of the hybrid funds have got a lot of money. But if you dissect it, there are certain categories which have got a lot of money. And I think those two categories inside the hybrid category, which have got the largest monies, are the large two opportunities. What are those two large opportunities? Now, multi-asset funds have got the largest inflow. Second largest inflow, and arbitrage funds have got the maximum inflow. So if there's 93,000 crores and out of which 58,000 crores comes from arbitrage fund, it's a great time to wake up and see what am I missing. And then the multi-asset also has got about 22,000 odd crores of net flow. There also we are missing something if you don't have it. So why are these two categories so relevant now is in the budget last year, there was a Section 50AA inclusion, which implies that debt funds which do not have 1/3 of the money in Indian equities are going to be taxed as short-term eternally. If I hold a debt fund for even 10 years, which is pure debt fund, I'm going to be taxed as a short-term capital gain. And debt fund as a category has had always HNI investors because the retail guy was happy with an FD because he's anyways not getting taxed. So the tax arbitrage was maximum there for the richer ones. And that's why there are only about 60 lakh debt fund investors, individual. But you have 4 crore odd equity fund investors. So it was just not the retail which was there in debt fund. So that money is moving from debt to hybrid, especially the multi-asset category, because of the tax arbitrage which exists between these two categories, pure debt funds and a multi-asset fund. The second, an arbitrage fund is again a great opportunity, which generally is called a hybrid fund, but it's got nothing to do with equity. From a risk return standpoint, arbitrage fund is going to give you about 7.5%, which is nothing but the cost of carry, which is the interest rates in the futures market. So these two categories have got the lion's share. And I think these two are opportunities. If they're relevant to you, it's most important to capitalize on.
Okay, got that. Since you were, speaking about arbitrage, I just want to take that a little bit, more forward. Take us through what the spreads have really looked like on this entire arbitrage space, and who do you think it is best suited to? Because, should any retail investor start considering this, even if it's for the tax benefit?
Yes, I think arbitrage funds have a larger space for people to participate. The spreads, coming to your first part of your question, the spreads are going to be anywhere between 8.5. The futures market, now let's assume Nifty. Jan 25th is the expiry, right, of Nifty for the month. Then if you move it to February, the spread on Nifty is about 150 rupees today on a base of 22,000. If you calculate it per annum for 5 weeks, if it is 150 rupees, then you will get about 7.5 to 8% kind of cost of carry, which becomes the return pre-cost. So what can you expect over the next 6 months from an arbitrage fund? Pre-cost, pre-tax, I think about 7.5 to 8. Okay. And post-tax, you can expect 7 if it's a long-term investor. Even the short-term investors for 1 month, 2 months get away paying 15% tax. It is the least short-term tax on a debt alternative.
Okay, and who do you think this would be best suited to? Some amount of investors or some category of investors for that matter?
Anybody who has any cash flow to be taken care of and you already have the money. Let's assume you got a bonus. You're gonna redo your house. That money should typically be in an arbitrage fund. If you're going to be buying a car and you have car down payment money ready with you, if still not finalized the car, then arbitrage fund.
Okay.
I'm giving practical expenses as example.
Okay, that makes sense. You know, the other space which looks interesting is this the BAF category, right? Because if you remember in the post-COVID period, we saw that big rise. There was a bit of, not post-COVID, during the COVID period, you know, there was a big rise in the inflows. Then there was a bit of a lull because investors moved to pure play equity. And now it seems to be picking up again. So how do you see this category position now?
It's a good category if you want to delegate your asset allocation. If you are a retail investor, this is the best category. Okay. Why? Because you're not going to have the time or the wherewithal to move between different assets, right? Today the Nifty is at 22,000. Are you going to be moving some money from one equity fund SIP units to another? You don't have the time and you shouldn't be doing that. So delegate your asset allocation to a BAF if you're a retail investor. Okay. And especially in a dynamic market like this one, I would certainly recommend that, because from October 2021, we have seen 18,000 and 15,000 three times. And we're back to 22,000. So this is a great period for a dynamic asset allocation fund. If the environment is dynamic and if your product is using that dynamism to capitalize on it, it's a great marriage.
So do you say that in times only when the market is dynamic, or do you think it should be a part of your core portfolio at any time?
No, I think the relevance of it amplifies in a period like this. But I think you can sit on a fund like that for about 10 years if you're a retail investor or you're just beginning out. If you're a 24-year-old and you really don't want to do that and you don't have the money currently, then that's a perfect start point.
Okay. You know, Feroze, the BAF category, yes, it can move very dynamically, but mostly it has a very, very heavy equity tilt, right? Around 70-80% is as high as it goes. What do you think about that? And, you know, is this something that will change, you think, during the course of 2024? Because, you know, we are expecting lower returns in terms of what is expected for equity. So do you see that changing? And with 70-80% kind of equity, does it really give you enough debt exposure anyway?
There are two parts. There's one disadvantage, one advantage. Now, let's assume you're managing your own asset allocation. How much do you think you're going to move around? Will you ever come to zero equity? The general movement is going to be, realignment movements are 10 to 15, 20% at best. And I think that they are doing. If your expectation is the fund manager is suddenly going to come to 30 equity, that's not the case, and he shouldn't be doing that. You're just trying to manage the froth. If you started this year with 60-40, with the kind of rally equity has seen, you've gone to 75. Will the fund manager bring it back to 60 without you having to intervene? The answer is yes. One disadvantage of this category is that you're going to pay a heavier cost on the debt portion. See, debt is a place where you should be very stingy, very miser when it comes to cost, because return ban rahi hai 7% ki. I can't pay 2% on a 7% return, 1.5% on a 7% return. That as a percentage, 2 rupees on a 7's base is like taking away 25% of my return. You don't have to be too specific on cost and equity side, but on debt side, I would be very, very picky. But in a dynamic asset allocation fund, the cost applied on your debt allocation is equal to your equity allocation. That's one flip side, but as long as your amounts are not in large quantums, then you're okay.
Okay. So, again, it is from a retail investor's perspective. What is the time frame you would recommend if one has to go ahead and invest in hybrid funds? It would again have a high equity tilt. Is it a longer term scenario that they should look at? You spoke about BAF, you know, at least 10 years. Is this the same across most of the categories?
Other than the conservative one, which you can afford to even sell in about 2 years, 3 years. But I think the rest of them, I think you should stay the course. Like you mentioned, Pavitra, they are heavy on equity. They may optically not be 100% equity, but they give you an emotional comfort. Because it's a hybrid fund, you're not as worried. So, because investing is about not pulling the plug at the wrong time. Every investor is a long-term investor till a catastrophe happens. Right? The guys who removed 1,22,000 crores from equity mutual funds in the COVID year didn't cut the check thinking I'm a short-term investor. They became a short-term investor. So, BAF helps you live the course.
Okay, I think that's you know, that could be one big advantage also, right? It just kind of helps you stay in that space as well. But Feroze, you know, you could also get your entire debt split by putting it yourself, right? Picking a debt fund and picking an equity fund as well, which some investors like to do. So what is the big advantage of picking a hybrid fund? Is it mostly just convenience?
It's convenience. It is management. But if you have, let's assume you have a portfolio of 10 lakhs. Would I delegate it to a BAF or a dynamic asset allocation fund? I would. If you're doing 2,000 rupee SIP, if I should still have some debt to anchor my portfolio, then a BAF. So anybody who has greater than 5 lakh portfolio should begin to do asset allocations themselves.
The pure equity funds?
No, not on a 3-year basis, of course, because 3 years back we were just at the 10,000 Nifty kind of level. So if you want to try out this fund from an outperformance standpoint, I think on a 3 to 5 year basis, even if you take time slices of mutually exclusive time periods, this will still disappoint you because of the debt allocation being a laggard. But having said which, it's not fair to expect them to deliver an alpha on a 100% equity portfolio. But if you then make an apple-to-apple comparison and compare them with a 70-30 separate asset allocation, like Pavitra was asking, if they've been able to beat that, then I think some of the funds have been able to.
Okay, that is good to know. The other thing I want to talk to you about is that there's so much talk these days about getting in on gold, right? It's been doing well, you're seeing the prices rise. So do you think at a time like this, if someone is putting money in right now, does it make sense to pick a multi-asset allocation fund over just a debt and equity kind of split?
I think the gold allocations, I personally don't prefer mutual funds because the government has made it so lucrative that the rest of them have become redundant. I know it's very repetitive, I would have said this numerous times, but the point is that if you're able to get 4% more, 2.5% of Biaj, and a tax-free status, that if you look at 10% return compounded, if you're exempt from a 20% tax, that's a 2% per annum more. So 4.5% extra post-tax return or pre-tax return is a great attractiveness. On the other side, you have gold minus 1%. So you have a differential of 5.5% between mutual fund plans.
As people say, mool se byaj zyada pyara hai, right? So people love that interest that they get, even if it's on something like gold. So say for a young investor looking at over 10 to 15 years of investment horizon, do you think they should start completely with pure equity portfolio and add debt later on because that's slightly more complex?
I can't agree with you more. If you read your principles, if you wrote down principles very well of your investing, that is when you will be able to go to 100% equity. If you're not very clear, it will not be easy for you to live with 100% equity. So write down your principles, whatever those principles are. But if you look at the compounding impact on equity is greater than the compounding impact on debt. This I consider as the magic of math. If a 3% alpha, if equity delivered 12 and you got 15, this 3% alpha on equity, if you could get this 10 years, it will be equal to your capital on day one. If you have 10 lakh rupees, in Nifty, if you grow it at 12%, you will get to 30 lakh rupees in 10 years. If you add a 3% alpha, which looks not so outrageous, you will be able to get your 10 lakhs to 40 lakhs. But the 3% alpha on debt is not so meaningful. So I would say that if you're young, what you have is time and compounding in equity. Even the extra return of alpha can give you very, very large values. So I would say 100% equity till you have your first expense in the next 2 years. Big ticket item.
Okay, got that. Feroze, very helpful chat on hybrid funds. So thanks for taking us through how you can approach this space and all of the different subcategories. With that, we're going to wind down on this MF Corner special. Thanks for tuning in. We'll be back with more.